Hello, everybody. Welcome to Talk Money with Tom, another Friday show here where we're going to try to answer your questions live. You can send them in. Ask Tom, talkmoneywithtom.com. If you want to send them email, you can put them in on the chat. We like to talk about things that we think are going to help people, in the area of investment management, retirement planning, tax planning, those types of things. And so send them in. Let's try to answer them. We do obviously have questions that come in during the week that we try to answer. And then with our strategy sessions with our clients, sometimes questions come up we think everybody should probably hear. So we cover those also. We do have, I think, a great resource here on this channel. You can go to subscribe to the channel itself. There's a little bell button if you want to get notified when something new is being posted. That's a great place to go. And again, the reason this happened, the reason we're doing the show, the reason I do these daily videos is just we feel very strongly that the higher the educational level in terms of these areas that we have out there, whether they're clients or not, the better retirement can work. So even if you're working with somebody, I think these are good things to know. Yeah. And so, and of course, if you decide that you just want to talk to us one-on-one, there is a button on our webpage. It looks just like this. It's a book appointment button. Our webpage, the link is here on the channel, and you can go there and hit that book appointment button and schedule a 30-minute time to meet with Ethan and I in office, the phone, the video, whatever works best for you as far as that goes. So look forward to being able to help everybody through this process as far as that goes. Now, I do like to start off the beginning of each week just talking about what we saw happening this week in the market. As of the beginning of the show, we were up a little bit today. We were down some, we were up some. But so far this week, we've actually been down, 4 days in a row, Monday through Thursday. Even though Tesla had a great earnings report, or at least their earnings report was actually good, but their forward guidance and the excitement that they were talking about what they were going to be able to do, they jumped like 20%, basically. Yeah, that's for a good-sized stock, that's a lot of money that got made in one day. However, if you look closely at the chart that I have here that we've been looking at for quite some time, this goes back into the middle of 2018. That little blip right up there at the top that's circled in red is the downturn for this week, which is, pretty minor in comparison to, the overall movements that we've had going back throughout time here. So things are still going quite well. We're still in a primary up direction. Still feel very confident in the market as a whole. Not a lot of things were reported this week per se on the economic standpoint, but more so in the earnings area.
Yeah,
right?
There's a lot more earnings week.
Right. Yeah, the telecoms came out today. That was kind of a mixed bag. Not today, this week. It was kind of a mixed bag. Of course, Tesla is big. Next week is the big week, right?
Yeah, you got PCE, you have some of the major tech companies. It's going to be a pretty exciting week.
Yeah, exactly. So PCE is that inflation indicator that the Fed pays the most attention to, and it's going to come again late. Here's the end of October, but it'll tell us what inflation was in the PCE, personal consumption expenditure basket. That could have an impact actually, because the market is reacting, to the fact that we've got a scenario where possibly, maybe they don't lower rates as much as thought because the jobs report has come out pretty well. The retail sales report over the last couple of weeks has come out. Was very hot, those types of things. And so the economy is doing incredibly well. Should they still be lowering rates in that environment? They consider it restrictive in terms of the rate is higher than what they would call the neutral rate, which is, I don't, if you can figure out what the neutral rate is, because even when they interview them and they talk to the Fed governors, I'm not sure they know either. But let's just say it's 3% for the sake of argument, and we're at 5%, and so we're still dragging on the economy. And even though the economy is good today, that drag could create a problem in the future. 6 months from now, 18 months from now, all of a sudden we're in some big recession because they didn't lower rates, and so. It's what makes it so difficult for the Fed is that you've got current data that's coming in that is showing certain things, in this particular case that things are pretty good, but the worry is because we're past this neutral rate, we might be dragging on the economy, and we'll find out too late that we should have been cutting rates in November. With November 7th is the next piece, and so there's been a lot of attention paid to why the market's coming down this week, and I'll give you my opinion. It's not what I'm reading in the press, but because what the press is talking about is an increasing interest rate. So like the yield on bonds has been coming up, which makes sense there's two potential reasons that yields are coming up that I keep reading about. Number one is things are better than expected, right?
Mhm.
And so the market, the bond market, the yields on the bond market came down quite a bit just because there was, during the summer, there was some soft pieces being shown, especially in the labor market. And now it's starting to come back up because, again, the labor market's getting better, big hot retail sales report, those types of things. The other thing is that we have a presidential election right now that is very, very tight. And basically the platform that Trump is running on, and this is the articles I've been reading, looks inflationary, right? Because if you start to do tariffs, right, on products, that's inflationary. Boy, they had a bunch of economists coming out talking about that. If you deport illegal immigrants from the country, which may or may not happen, but is part of what he's talking about, those are where basically the lifeline of our food comes out of that group as far as that goes. So who knows what actually happens? The rhetoric on the campaign trail and the actual what you can do are often two different things. But both of those are putting pressure on the yield market. And the thought process there, just to go to the extreme, if I could get a 10-year treasury at 10%, okay, I'm not going to buy stock market that's been averaging 11% over the long term because I can guarantee my return from the U.S. government over the next 10 years at 10%. Now, we're not at 10%, but we're at kind of in that 4.5 range over the last several periods here. And that becomes more competitive. We've seen it a lot. We've seen clients buying T-bills, CDs, things that they weren't buying not that long ago when rates were so low. I mean, when you could get a CD at less than 1%, people weren't that interested because now the market's making 11. So that's a really important component to understand about the whole market is that sometimes the competitive forces, whether that's real estate or bonds, can offset the potential gains that you might get in the stock market. And so it's why you kind of want to have a diversified portfolio. You want to have that bond market portfolio and that stock market portfolio, and hopefully some real estate. Usually it means your own home, as far as that goes, to kind of compensate for when that money is moving around, as far as that goes. However, I'm going to throw in another reason why I think the market's having some trouble this week, and might continue even a little bit here, and that's because of the election. Okay, so there are forces here. Well, here's the thing. After the election, if the market's going up, we still have these same inflationary forces, right? And all of a sudden that storyline gets dropped. And so usually what the news is trying to do is attach something to actually what's happening, which makes sense. I don't have a real problem with that. But if we look back, we presented this chart. There we go. We presented this chart some time ago. This is elections, presidential elections going back to 1952. And so it's the Dow, the S&P 500, and the NASDAQ are the three big columns there. And so it's just 2 months before Election Day. What happens to the market, right? If we look at the market, the one that's really, really went up was 1996. I mean, the S&P 500 was up 10% over that. That's unbelievable.
Yeah.
But it kind of sticks out also, and that was the time frame we were dealing with the dot-com, bubble that was happening, and the market was super strong and what have you. But if you look at virtually all of the elections since 1996, with the exception at the S&P 500 was up 1.1 there in 2004, but the last 5 elections, 2008, 1, 2, 3, sorry, 4 elections, all negative. Yeah, on the S&P, negative 18.7, 0.3, negative 1.9, negative 2.5, etc. And so that would be the expectation that I would be thinking is going to happen. And again, my explanation for this is that there is some money that might be held back during that 60-day window because we want to see the makeup of Congress, which might be more important actually than who the president is. Is it bifurcated? Is it all one party? How does that party relate to who's in the White House? Is the White House and the Congress completely controlled by one party? The thought process there is more of the agenda could get done. It would be good as an investor to know what the agenda was and maybe to bet on that agenda, right? Because now they control everything.
Yep.
I don't happen to agree with that personally because too many things can happen. I'm just going to respond to what the market's doing. All right. But That doesn't mean that there aren't other people out there doing the same things. And so that money that gets held back in that 60-day period just starts to come in once we know the results. Once the clarity is there and we know the results, the market generally does well after that. And here's a good example. So this is 2020, the last election.
Yep.
I've highlighted here September, October. Not exactly 60 days, but we'll get the same point. You can see in September we had a pretty good sized drop, right? I think that was about a little over 10%. Then it came back almost all the way in October, fell again, right? That's the norm. First of all, seasonally, September is a negative month, going back to 1928 anyway. And so you combine that with the uncertainty. But then look what happened to the market just before the election and then continuing on after. I don't know, that's probably not quite a 45-degree angle there, but pretty close, right? It continued to move up. Again, that's kind of the norm in this case. And it happened, in 2016, the market went up when Trump was voted in. It happened in 2020 when Biden was voted in. So it doesn't seem to really matter who is elected president, at least in this time frame. I think longer term it does. We saw, Trump was going after tariffs at the end of 2018 in China, and the market dropped 20% because it doesn't like tariffs. And so, the inflation could be roughly correlated with the big bill, the $1.9 trillion bill that went out for the COVID relief at the beginning of 2021. Inflation started right after that, et cetera. So there are things that can come out of the agenda that can affect the stock market one way or another, and even the economy one way or another. However, in this time frame of the post-election run here, it has typically been quite good.
Yeah, because the next president doesn't take office till next year, so you have
That's
a few
right.
months of just this kind of dead, lame duck Congress, kind of in a sense.
Yeah, and you're sitting on an economy that's doing well. You're sitting on earnings that are growing, and the money was out of the market that might have been in the market for that 60-day period comes rushing in. And so, again, I think we just have to have some patience here. Don't be surprised at all if next week isn't also a down week, in my opinion. The thing that can drive next week, though, is the earnings of these big companies. It's kind of it's an interesting mixed bag. I always like an Amazon will come out with something I think looks pretty good. They'll say a few things about their forward guidance and lose 6%. So it's hard to tell with earnings what's really going to happen. As a matter of fact, in my experience, during the heavy portion of earnings reporting, the market just kind of goes up and down all over the place. Once that's over and the totality can be looked at, we realize, hey, 70, 80%, let's say, for example, of the S&P 500 companies exceeded their earnings expectations, and the market generally can start to move again. So, we're going to have an unusual 60-day period because September was actually up this year, right?
Yeah.
Which technically, if you look back, we did present a chart in our show some time ago that during presidential election cycles, September is actually slightly up versus being slightly down across all September timeframes. And we kind of achieved that. We weren't up a lot, but we were up some because it dropped a whole bunch, just like it did here, kind of in that first week. And then recovered and actually made a positive month out of it, unlike 2020. But I think that rate cut was the differential. There was no rate cut in this time frame prior to the last election. So having that half a point, which was somewhat of a surprise to the upside in terms of the size of that. So I think we just have to exercise some patience and stick with what you've got, and let's wait and see what happens. I am a little bit thinking that the market might not do quite as well after the election because it's already done fairly well. If we go back and look at the market here, it's done pretty good. I mean, it's up there already. So stretching that even further on a year that's already had a big gain, we might not have the same kind of explosive growth that you're kind of used to after a presidential election, just because of the fact that we're already up there. And it's already done quite well to get there. And maybe we don't have, exactly the same stretch to the upside. And maybe that's better, honestly. I like that slow, steady growth in the market where the earnings can kind of keep up and the market doesn't get so overpriced. It is, out there already. So, keeping that gains at a steady pace, I think is better. It doesn't really work that way. This market is a representation of human emotion, and we are nothing but slow, steady pace is just not especially when you're talking to a group mentality, which is what you're talking about here. So anyway, it's been a good time frame to be an investor. Really interesting time frame. So we'll continue to watch things. We have had very little changes in our portfolio recently. We were getting a lot more rotation in the summer than we are getting now. Just from what's coming up in our list of ETFs that we're following, what have you too. So anyway, good time to be an investor. Stick with it. Let's see what happens after the election before we start to draw any real conclusions about what's happening now. I think that force is larger than whatever forces we're seeing that are coming in and reporting, economic reporting and earnings. I think that force outdoes it, and then maybe that force continues to outdo it on the positive side after the election. So let's see how this plays out. But thank you for joining us. I love covering these. I wasn't able to do Monday through Thursday the daily, so just being able to do the weekly this week is good. Other than the fact that the market dropped all 4 days, that I didn't get to do the video. There wasn't actually a lot of news that was super constructive as far as I was concerned, maybe except for the Tesla story, which I think is kind of fascinating. All right, thank you very much, and let's get to our first question.
So why are mortgage rates going up?
Yeah, well, okay, so mortgage rates are what are they at now? 6.5-ish?
6.9 actually.
6.9. Okay.
So they've gone up in the last month. I think a month ago it was about 6.1. So.
Yeah, we do have a chart here. This is a survey of different mortgage rates. The blue one is the Mortgage News Daily. The MBA is the I don't know what color is that. Some darker color, and then the orange is Freddie Mac. So you can kind of see, over the course of this year, for the most part, starting in April, rates have been coming down. Mm-hmm. Yeah. And when they did the 0.5 point cut in September, rates did come down some, and there was a flurry of refinancing activity. Mm-hmm. You look at it got up into that near 7.5% range in April. So if you bought a house then or refinanced then for whatever reason, and all of a sudden you got down to 6.2 or something, which is where it kind of looks like it bottomed out at, you might go ahead and refinance at that rate. However, what that does is the mortgage market is just like any other market. It's a supply and demand market. Mm-hmm. And so when the rates come down and everybody starts to refinance, there's only so much money available to do mortgages. It's not an infinite supply. Yeah. And so when the demand is higher, they can raise the rates because they can, even if it's not related completely to the bond market. Which, even if the bond market's coming down, if for whatever reason everybody's trying to get mortgages at once or refinance their mortgages, you're going to dry up the pool of mortgage money.
Yeah, and there's been also a rise in the yields. The 10-year has gone up from like 3.25 to 4, or 3.75 to 4.25. So it's gone up about 0.5%. And so, mortgage rates will also have like some sort of correspondence to the, just what you can get on the federal market.
Yeah, and it's not a perfect correspondence because it does have its own supply and demand, world that it's living in. But yeah, over a period of time, there's a pretty strong correlation to, say, the 10-year yields and the direction that those yields are going and the direction that mortgage rates will go. So if you see the yields on the 10-year jumping 0.5%, expect, at least at some point, if not immediately, a jump in the rates for mortgages, right?
Yeah, and I think it's also the change of expectations for federal cuts.
Yes.
We were originally thinking, we were going to have, 3/4 of a worth of more cuts. Now we're down to maybe could be possibly just a quarter.
Yeah, in that September rate cut at 0.5%, when we looked at the CME Fed Market Watch tool that shows the futures market bets on where rates are going to go, I saw it get up to 58% probability that we were going to have another 0.5 point cut. That is now gone because the data that's come out since that 0.5 point rate cut has been good to the point where there is no expectation, at least on the futures market, for a 0.5 point rate cut. Mm-hmm. And there's even some slightly growing expectation that we might not have a cut at all, although the majority, I think it's still over 80 some odd percent.
It's at 97.
97, there we go. Yeah. So it's a 97% probability as far as the market's concerned, we're going to have at least a 0.25 point cut. Okay. And so, that of course, when you're looking at that as a mortgage, this pool, these guys, they're trying to get the highest rate they can. It's competitive. They can't say, hey, we're going to charge 8 when everybody else is charging 6.5. But it can all move up together as the demand comes up, and the yields start to come up because the Fed may not be cutting rates as much, and that affects the stock market also, generally speaking. I think overall, I wouldn't be surprised to see mortgage rates stay in kind of that similar range, kind of 6 to 7% range. You would need to see some type of economic weakness in my experience. I don't know, they might continue to slowly but surely lower rates even without economic weakness because they're trying to get back towards this neutral rate. So if neutral rate hypothetically is 3% and we're at 5%, we could see, as a matter of fact, in the statement of economic projection that the Fed put out on their September meeting, they have what's called the dot plot, right, where everybody puts down where they think rates are going to be, and the average decrease in total was 1.75% from where they were, which was 5.25 to 5.5. Fed funds rates are always in a range, so a quarter point range, 5.5, 5.25. And so, we move it down to a quarter point, a half a point like they did. Now we're at 4.75 and 5, right? And so what they're saying, at least in that dot plot, is we still have a 1.25, drop coming over the, next year or 18 months. Now, take the dot plot with a grain of salt. They do it, which it's an interesting exercise. But almost nobody, including the Federal Reserve, can really tell what's going to happen over that long of a period.
It's their educated guess. Would be the best way of saying it.
Yeah. So if that happens and we get another 1.25 point drop in rates, then mortgage rates will get a lot closer to that 6% and maybe even fall below that. But the compounding factor here is that the economy continues to perform. It continues to do well. And I've been saying for a long time here, at some point in time, China's going to kick in. Maybe that doesn't happen in the next 12 to 18 months. I don't know, but it could. And we saw the Chinese stock market go crazy over the stimulus plans that were happening. And now the stimulus plans are a little bit more murky and the market's kind of coming back down. Because I think that's another inflationary force for the entire world when China kind of comes out of this, situation that they're in now and gets moving. They're the second largest economy in the world. They will travel, they'll do different things that could create some inflationary force themselves. So I don't feel like inflation is just going to start falling to the point where the Fed feels very strongly that they need to lower rates. As a matter of fact, right now, I think they're lowering rates more for the job market. And the job market's, it was better, right?
Yeah.
But it's within the realm of kind of what they're talking about, which is around a 4% unemployment rate, right? And there's other criteria. These are the ones that are easy to talk about. But, that's so anyway, with mortgage rates, maybe it will be lower here shortly in within the next 12 months. It might be able to get something below 6.9%. And so, if you already have a mortgage that is less than 6.9, you're not gonna refinance. If you're at 7.5, like maybe somebody got here at the top, I don't know that 6.9 is the number that I need to see to do a refi.
Yeah, I can see the low sixes where you start to get away where people are refinancing.
I always did like at least a 1%. It's a pain to do. It's really hard. Worth it in the long run because boy, you can pay that forever. So, but if you're going to buy a new home, I don't know what's the difference between 6 and 7. Not that much, really. It does matter in terms of your qualification and your income levels to be able to get that. If I had to get a house and I had the wherewithal to get a house, I wouldn't worry about the difference between 6 and 7 because you can always refinance.
Yeah, you're never locked into this rate forever. You can always have the option to refinance later on.
I got my mortgage originally at 8%, or maybe 8.25, as I recall, and that was a good rate at the time.
I remember my parents talking about how they were at 14% when they first started.
Yeah,
so.
Exactly. And so that, and now I'm at 2.75, right? And your parents probably were down there too. Like everybody that got the chance to refinance. Kind of in that 4% or lower range. And so I suspect that they'll come down, but be aware that they might not come down as fast as everybody seems to think. And maybe even the Fed isn't going to be lowering rates as much as they think. I think the economy is stronger than people think. and that's been true. I've been saying that for a long time, and some of these numbers that are coming out now are making that sound, more reasonable. So we'll see. Past 12 months, maybe the overextension of rates above the neutral rate caused enough of a slowdown to create a recession in late 2025 or, first half of 2026. And then you would actually see the Fed maybe moving back down into that, 3% kind of rate. And then mortgages could really come down. And again, at that point, you could refinance if you want. But there's multiple aspects. What yield is the bond market paying now? And, what's the supply and demand in the mortgage market? Yep, that's a good question. All right, what's the next question?
Is it bad to open different accounts for different purposes, just to have a lot of or multiple accounts for just each have a unique purpose, kind of?
It just reminds me of this story. I remember meeting with this lady, a really nice lady, and I was actually at her home. She was older, and she brings in this grocery bag, right? And she pours it out on the table. And there's passbook savings. This was a long time ago, back when we used to get passbook savings. There must have been at least 40 passbook savings accounts. And I'm talking to her about it, and what had happened was that this was back when the banks were giving, a free toaster if you open an account, and there were a lot more banks to choose from. There were a lot of little regional banks. They're not like today where it's a bit more consolidated. And so, we spent a lot of time figuring out what was in all of that, how to get it all back, those type of things. And so here's the thing, and I remember another lady who his husband just passed away, and she came in again with a grocery sack full of envelopes. And in that particular case, the husband had just been opening things. It created a nightmare for her. So if you are going to open, it's just sort of an opening statement. If you are going to open a lot of accounts for some reason, if somebody else is going to end up taking over that, just keep it a bit organized so they can figure it out.
It's within moderation.
Yes,
It could be simple, like for myself, having an investment account for a down payment. You could,
yep.
You could have like, I would keep it for your major goals. And you don't need every little goal to have its own bank account, or investment account. So trying to keep it still broad and moderate, but it's not a bad idea to have it, because it's nice to have like one specific purpose, and then looking at that account and seeing it grow too. It's nice.
Oh, it is. So that's sort of the mental side of it, right? So for example, we've had a lot of people talk to us about college funding for their kids. And so, a 529 plan is a great college funding option because you can put money in. In some states, you can even get a write-off for putting money in. Not in California, unfortunately, but nonetheless, it grows tax-free. So you can put it in the stock market when they're young and let it grow, as long as you take the money out for, college-approved costs. But one of the problems is, here I got a 2-year-old, I'm putting money into this 529. Are they going to go to college, or what have you? Now, 529s can be reallocated to any of your other children, yourself, the next generation. I mean, it's kind of nice. But one of the things that people are worried about is maybe over-contributing to that and ending up with a bunch of money kind of locked in. You can get it out. There's some we won't get too far into that, but one of the recommendations that we have is maybe opening up a separate account that's just in your name, you and your husband's name, the trust name, whatever it is, a transfer on death account, whatever, what we would call a taxable account, which just means that it's not inside of a tax shelter of some type. And that's mentally designated for your children's college education. So some money goes into 529, some money goes into this other account. And then, if they don't go to school, you could use it for something else, whatever that might be. And maybe it's to help them, with their down payment or, whatever it might be. So there's nothing wrong with that. I will say, at least in my experience, the older we get, the more accounts we tend to accumulate.
Yeah.
And it can be really difficult once you get into retirement when you have, 10, 20 accounts or something, which we've seen many times. And trying to keep track of it and trying to understand where everything is, it gets to be a bit overwhelming, because technically when you look at what you really have to have, right, you're going to need something at the bank. It doesn't. You can have multiple things at the bank, but you
Yeah.
got to at least probably have a checking account at the bank. That could be in the trust. That could be in your personal name. There's different ways of looking at that. And then you're going to want a taxable account, an investment account, right? And that again could be in a lot of different. It could be in the trust, be in your own name, joint name, transfer on death, whatever. And then if you have an IRA, that has to be in your own personal name. So if you're married, then maybe both have them. So now I'm up to what, 4 accounts: bank, trust, or taxable account, 2 IRA accounts. Let's say if it's a husband and wife, if they have Roth, right,
Yeah, there's
IRA,
another 2
there's
accounts.
another 2 accounts. Man, that covers most of it, right? Those
Yeah,
are
you can use those basically. That
yeah,
would be 7 accounts, right?
7 accounts, and that's with a Roth. Not everybody has a Roth,
Yeah.
but
You could cover. You would have all your bases kind of covered with.
yeah, you could cover everything that I can think of with those 7 accounts. Now, is it okay to add another 2 or 3 because I have these special things that I want to save for? Yeah, sure. Because now we're up to, depends on the Roth or not, but maybe 10, right?
Yep.
So that's manageable. But if I already have 20 or 30 accounts, I'm adding more.
Yeah.
It's we can kind of keep track of it pretty well, and so can the public with this software that's out there. That does help.
Yeah, they love the aggregate softwares that
Yeah.
take all your accounts and kind of puts it into one like dashboard. It
That's
can
right.
really help.
So you could have 20 and kind of look at it as one on this software. It aggregates it all together because that's what happens for us. It doesn't really matter to us how many accounts you have per se, other than the fact that, we have to open them and set them up. And then every time something changes, we have to change them, so it's sometimes a bit more cumbersome. But nonetheless, that's not it's not a real difficult thing to do. So, yeah, I don't have any real problems with opening up additional accounts. I just, there's some balance in there someplace, like anything else. Moderation would probably be best to look at. But I actually think mentally it can be very powerful to have, as Ethan said, as you're starting to build up that down payment account, that's pretty motivational,
Yeah.
right? I would imagine. All right. What's our next question?
When should I update my will?
My will. Okay, so not the trust.
Not the trust, just the will.
Okay.
So we can start with
Yeah.
changes in the family. So maybe your partner passes away, there's a divorce, so just like the household kind of changes.
Yeah, beneficiary changes basically, right?
Yeah, and there's also like a beneficiary has a major life event. So they get married, they have a child. Maybe you want to update your will, to include that grandchild, stuff like that. If you move to a different state or country, because each state has kind of different laws, and each country will have their own laws, and so making sure that your will is still up to date for your basically where you're living now is important too.
That makes sense.
It could be something like you have a significant increase in assets. Sometimes desires change when you have different a substantial increase in assets, or just in general desires change. You could be super specific, like say for Tom with his his restored Volkswagens, maybe he gives it to his son rather than his daughter because his son has a little bit more interest in them.
Yeah, it's an ongoing living document. Things are changing for you. Things are changing for your family, your beneficiaries, and just keeping that up to date is certainly when you should be updating it. With trusts, they talk about updating trusts every 3 to 5 years because the laws that go around trusts change.
Yeah, and you can just update your will on that same cycle. Like your will doesn't really have to update, but just reviewing it every so often to say, hey, everything looks, what I want. Essentially, you want to fulfill your desires.
Yeah, the laws around wills are more stable than the laws around trusts, but that would be something. You don't want to have what you think is going to be an adequate document to pass your assets and find out, your beneficiaries or executors finding out that it wasn't, because, it was written 30 years ago and something changed. And so, that would be another reason to update it as far as I go. But I would believe the most common updates come around changes, within what you think or changes for your family, changes for your beneficiaries and what have you. So. It's good to have that and have something spelled out.
So, where should I save money after fully funding 529 for my children who are minors?
Okay, so we have children that are not yet 18. We're already fully funding the 529, at least in our opinion, right?
Yep.
And so then where do you save money thereafter? There are some options for saving money in their name beyond the 529.
Yeah, so you got an UTMA,
UPMA, which stands for Uniform Gifts to Minors Act. No, Uniform Transfer
transfer
UPMA.
minors.
Minors Act.
Yeah.
Sorry, we unfortunately in our world, as in most worlds, you get it just becomes the acronym. Right?
Yeah, it's just easier to write, and then it saves you a lot of time, and so you always forget what it stands for.
Yeah, exactly. So we're RCS inside our place here. We never talk about retirement capital strategies. We talk about RCS. Okay, so. But there are some restrictions on UPMA that can be kind of onerous. And
yeah, essentially, once a child reaches age of majority, depending on your state, that basically all the asset that's in UPMA will become theirs, and that can be good and bad in a sense that if they get a large windfall, do you trust them enough that they could handle it? Another thing is if your child is let's say they're a teenager and they're working, could you save into a custodial Roth?
Yeah.
So the idea is you can help them out, start with a little bit more retirement. Anytime you go above your annual gift exception, though, exclusion, you're going to eat into your lifetime gifting.
Yeah.
So you have to remember that too. So usually to fully fund the 529 is you usually do the annual gift exclusion.
Yeah, exactly. And so, the other way, and the way that we have often set it up, is just to set up an account that's in your name or you and your spouse's name or your trust or whatever it is, and mentally designate that for the child, right?
Yep.
And that way you completely control it. There's no limitations. They don't get it at a certain age. You can decide and see what happens and what they might need. And kind of use it in that regards. And if you end up having to use it for yourself because you fall on financial difficulties that you weren't expecting, it's right there, it's yours. It's not locked up in some 529 plan or an UPMA or what have you too.
Essentially, once you go into those accounts, you really lose control of like how you pull them out. It's just restrictive.
Right.
And so having something separate can also be convenient.
Yeah, which I think is a great way to go because college isn't the only possible cost that your child might be facing that could come up. It could be medical issues. It could be, getting their first car. It could be helping them with the house, starting a business, right? I mean, Bill Gates, I've forgotten the exact dollar amount, but his father was one of the seed funders in that in Microsoft. I think it was 50,000 is what I recall. So what a great investment that was. I mean, for the world, really. So anyway, you never know where you might need money for your kids as far as that goes. All right, I think we have time for maybe one more.
Should I start saving for a goal if I'm uncertain it will happen? Is it bad to save for uncertain goals? I don't think it's a bad thing. For example, I'm saving for a down payment for a house.
Right.
There's I don't know if I'll ever, I think I want to buy a house, but I don't know for sure that I'll buy a house.
Yeah.
And so there's nothing wrong with saving for that because at the end of the time, you still have the money. It's still there, and you can spend it on something else.
I think savings is the key issue there because that's the difference, right? Our clients are good savers, period. And the people that don't have the money in retirement, they either weren't able to or weren't willing to save, right? So, I mean, and so no matter what helps you to save, even if it's a vague concept, like, okay, I don't know if I want a house for sure. There's pros and cons to it. They're expensive, and that kind of thing. And so, but I'm going to save for it. And if it causes you to save money, that's perfect. I'm telling you that if you sat in my seat for the last 37 years and you watched, how this works, and you look at the people that have had money and you look at the people that haven't had money, the difference, the main difference is just savings rate. Period.
Yeah, I think 80% of the work, you can get 80% of the work done just by saving.
Yep, exactly. And now you combine that with good investing, that's great. But I've seen people flip that around and they don't save much and they try to just really focus on the investing and get it going. If I have $10,000 invested, and I make 12% rate of return, I make $1,200. But if I have $100,000, I'm making 12,000. So it's the ability to save and continue to save that insulates you from potential future issues and dealing with things
and that's
in the future.
and creating that habit just snowballs for the
Yeah.
rest of your life, and having that base, so it just keeps snowballing, and it keeps compounding up, and so it's a very powerful tool.
Yeah, I wish you could sit in my shoes and kind of understand, and how often I've heard, "Oh, my dad told me to pay myself first," or I was told to put at least 10% away and live off the rest and just pretend like I never got that money.
Mm-hmm.
And here they are sitting, in their retirement or heading into their retirement with literally millions of dollars just because of that, training that they got. And it's amazing because you can see it, and then their parents pass away, and they get that money that parent was able to save, and then their kids, we meet their kids, and they're savers too because they're learning the same thing. And this is unfortunately not something that's taught in school, at least that I've seen, or not very commonly, and it's taught at home. And so something to really teach your kids as they're growing up is to kind of put that money away. Pay yourself first, spend the rest, pretend like you didn't get it. These same things, these people remember the exact words that they heard, and it's that's the difference. I'm telling you, it's not. I expected when I first got in this business, I was going to meet all these great investors, people that really kind of knew what was going on with the markets and such. That's not true. What I did meet was a lot of great savers.
Mm-hmm.
Yeah. So anyway, that's great questions today. Actually, I really appreciate that. So again, send in the questions now for next week if you want. You can send them to our Ask Tom at talkmoneywithtom.com address, and we'll try to look up some information, maybe find a chart or something useful to kind of describe our answer as far as that goes. Love to hear the questions. And obviously, if you want to, you can subscribe to our channel. You hit the subscribe button that looks just like that. You go to, the little bell if you want to get notified.
Mm-hmm.
And then, of course, we're always available for an appointment. You can set up a 30-minute time on our schedule. Go to our website. Book appointment is up in the corner. And our schedule's on there, and you can pick a time that works for you. So really appreciate everybody coming today. Really a great show today. Thank you for all the great questions. See you again next Friday.